Welcome to our quarterly investment market update. Steve, we've just completed the April to June quarter investment market review. It's been a very, very volatile and difficult time for investors during this quarter. Can you give us a bit of an update as to where the Australian share market ended up?
Yeah, sure, Sam. Well, this won't surprise anyone, but it has not been a great quarter for any markets around the world, including the Australian market. In fact, in the first quarter of this year, that's when all the overseas markets were falling down. Australian market had a small positive return, but we've now caught up to the rest of the world. And you can see here that the Australian market's down minus 11.9% for the quarter. And it also means it's a negative financial return as well, Sam.
Yeah, so it's all the modest returns that we actually saw in the first 3 quarters of the financial year have sort of been wiped out, and some by the end of 30th of June, which is unfortunate.
It is unfortunate. We should say, though, that negative financial years are not as uncommon as you might think. I was just looking at some data that looked at, there's been 6 financial year negative returns in the last 30 years. So it's not that uncommon, not pleasant, but not that uncommon.
And what about the international share market, Steve?
Yeah, just briefly, Sam, you can see here that the rest of the world, negative, of course, they're down by minus 8.4%. And the emerging markets are negative, not as bad as you might think. They're down minus 3.3%. Emerging markets are made up of China, constitutes 30%. And China, believe it or not, had a positive return this quarter, but it's had very bad negative returns prior to that.
And the big tech stocks?
Yeah, so we've probably heard about the big tech stocks, and in the US market is down, it's been down 20% over the first half of the year, and that's what they call a bear market. And the big tech stocks, they're the ones that reside in the NASDAQ. They're the FANGs, Facebook, Apple, Amazon, Netflix, Google. They've been down by 30% over the half year, and they're down 25% for the quarter.
So the significant losses that have been incurred on tech stocks have really acted like a lead balloon on the broader markets over the last quarter.
Yeah, it really has. I should say, though, Sam, that the US market and the big tech stocks have been the best performing stocks over the longer run, so it's not surprising that they're the ones that have come back the most and pulled the market down.
Yep. And what about the bond market, Steve? Typically bonds act as a bit of a defensive asset class in client portfolios, but they really haven't shown those defensive attributes over the last quarter.
No, in fact, it's been the worst half-year return for bonds in more than 50 years. It's really started in the first quarter. The bonds were the first to take the hit before the equity market did. And even now in the second quarter, they're still down, not as much as they were in the first quarter. In the chart you're seeing now, you can see those quarter by quarter returns, but you can also see the bond yields. Now, bond prices are a reflection of what bond yields are doing. And you can see the bond yields weren't doing very much in the last half of last year. And then, of course, towards the end of last year, we started to hear about inflation. And it's inflation that causes bond yields to go up. And that's what you've seen in the first quarter and now in the second quarter. But Sam, you can also see in that chart that those bond yields have turned around in the last few weeks. And many commentators are saying that bonds may well have hit their bottom. They're now returning 3.5% for a bond portfolio, and it's probably not likely to go negative. Bonds are now there to perform their typical function of actually being a safe haven investment if equity markets continue to fall.
So the difficult environment that we've experienced, should investors be making drastic changes to their portfolios, or should they be holding steady? What would you suggest?
Yes, and of course we don't know what's in store, whether the equity market will keep falling down or whether it too has sort of reached the bottom. But what we do know in the data we're putting up here is that after a market downturn, markets recover fairly quickly. So you can see in the chart here, after a 10% market downturn, the market had fully recovered within a year. And the same for a market downturn of 20%, the market had fully recovered after 1 year, did even better after 3 years, and better still after 5 years. Yep. A big downturn, 30%, takes maybe a little bit longer, but after 5 years, you're still seeing positive returns. So the answer to your question, Sam, is investors should stay disciplined, stay in their seat. Market downturns are not that uncommon, but they don't tend to last that long, and we tend to recover from them fairly quickly.
Yep, so long as we continue to focus on quality assets as opposed to speculating.
Exactly.
But thanks very much, Steve, and to everyone viewing this, please keep in mind that Insight Private Wealth is independent and we do not receive any sort of investment commissions, nor are we owned, controlled or influenced by large banks, super funds or any other large institution. This ensures that the advice that we provide to clients is absolutely professional and in their best interest. So if you'd like to find out a little bit more about how we can help you, please don't hesitate to contact us. We'd be glad to help.